Well, thank you very much for inviting me here. So my name is Shamyl. For the last 5.5 years, I'm running a prop trading book for a French Muslim bank, Banque Nationale de Paris, or also known as BNP Paribas. For those of you who are interested in tennis, I think you will know the name. Apart from that, a lot of people know it as very small Muslim bank. My activity is a part of prop trading group, which every investment bank has. What is prop trading? Prop trading is every bank has its own capital pool, and there are usually 30 to 40 guys who have access to that capital. And with that capital, you invest in different activities. No, I'm not talking about investing in stock markets or bond markets, something like that. In certain strategies, it could be convertible arbitrage. It could be pure long-short equity. I'll be explaining that a bit later, a bit in detail. But the idea is that you use your own capital to take risk for the whole bank. Recently, with this crash and everything, a lot of these guys have been blamed. I'll be clarifying a few things about prop trading in general. That all prop trading groups, investment banking, especially in Anglo-Saxon investment banks, made money during this crisis. A lot of money was lost by some guys who took some extraordinary risks. Those guys did not belong to prop trading. It was coming from the client-driven activity. On top of it, my activity is niche activity. It's very small in nature. It's high frequency, which means that you don't have any positions at the end of the day. You're flat. You start the day at 7 in the morning. At 9 in the evening, all positions are closed. Your P&L is locked. So you don't take any risk overnight basis. You take risk intraday, but it doesn't show up on your balance sheet of the bank, how much risk that you're taking intraday. So that makes it quite fascinating in general because not a lot of people know about it. And on top of it, all of it is misunderstood. Especially, I don't know if you've been reading Wall Street Journal for the last, I think 3 months. A lot of things I've written about high frequency. I'll be clarifying, a lot of it today about how the modus operandi of these particular group pairs actually. So we'll start off with strategies, the basic strategies that we're using in high frequency group. The definitions, because a lot of this is technical in nature. We'll be talking about market structure. So I'll have to start with the US, and then we will start with, we will go over to Europe, a bit of Asia, and spend some time in Tokyo. And then again, why do we need high frequency proprietors? What is their benefit to society in general, stock markets, for example? And then, of course, we're going to compare the revenue generated by high frequency with investment banking in general, and how it compares. And then in the end, of course, I'll be talking about some myths about high frequency activity in general. So what is it? Two groups. One is ELPs, electronic liquidity providers, and the other is classical arbitrage. The first group is basically a market maker. It's totally electronic. Before the advent of electronic markets, I'm talking about 96, before 96. Every time you wanted to trade, you had to call a broker for big size. I'm not talking about retail bankers, retail investment anymore. I'm talking about institutional investment. You would ask for a price. Let's say you wanted to buy 10 million of Microsoft. So you would call the broker, and the broker would quote you a price. That would be a bid, that would be an offer, because you're not going to give him his position because you can, front run you. So that broker is basically taking on your risk, and then making money doing that. So the idea is basically very simple in nature. Market maker, you just make markets. It can be for any single asset in the world. It can be for stocks, bonds, subprime securities. It could be for exotic products. I'll explain a bit later on. So the idea is that at the end of the day, you don't have any positions left. You trade Microsoft all day long, but at the end of the day, for example, you won't have any position left in your portfolio. So at the end of the day, it's zero. So this makes it like really, very fast-paced market in general. On top of it, you capture the bid-ask spread. The bid is at 20.01, for example. The offer is 20.02. Spread is 0.02, 10 basis points. So you're trying to capture that 10 basis points with which size? 10 that 10 bips or 20 bips, I don't know which you're going to capture eventually, over 10 million. You're going to do it like hundreds of times in the day. So you're going to keep on repeating it all day long. So the idea is very simple in nature, market making. The second activity is much different in nature. It's really small, but the idea is that you're going to discover small inefficiencies between 2, 3, or hundreds of assets. Let me give an example. Two stocks which are very correlated. Peugeot avec Renault, Daimler avec BMW, BNP avec Société Générale. Same sector, same activity, almost same size. I'm just giving an example. Renault goes up 20 bips, and at the same time Peugeot goes down 20 bips. There's an arbitrage opportunity. I see it and I say, listen, what's going on? Why is Renault going up and Peugeot going down? So I'm going to go in, start buying Peugeot, and start selling short Renault. So I'm trying to capture that small inefficiency. That's 40 bips. If it comes, back to mean inversion happens and eventually comes down to 0, I've just generated 40 bips with really small risk because I didn't take any market risk. I bought Renault. So I mean, the idea is that I don't take any speculative position at all. It's very statistical in nature. I know that 98% of the time that it reverts back to normal. If it doesn't, I'm screwed. But most probably it would, because statistically I've backtested it for the last 4 years and eventually it comes back 98% of the time. For those 2% of the time when it doesn't come back, well, in that case I have some stop losses in place which will automatically trade for me and cut the position and I'll restart maybe not at 20 bips but at 200 bips. But I'm going to keep on playing it because eventually one thing that always works in stock markets is mean reversion. Everything is mean reverting. Whatever goes up must come down. You can talk about bubbles, you can talk about stuff like that, but it has to revert. I don't know how long it's going to take to revert. It might take 5 milliseconds, it might take 5 days. I cannot hold the position for 5 days. We can hold the position till the end of the day. So if it comes, back at the end of the day, I'm happy. I've just stopped my profit and walk away. So the first problem is, again, you have to identify the relationship between instruments because you cannot trade, I don't know, Goldman Sachs with, let's say, Peugeot because it's not in the same sector. They don't trade, they're not correlated at all. You need to have some rational justification why you need to trade. And then latency is increasingly important. Why latency? Because all of these guys are co-located. What is co-location? Co-location is when you put your own server on the exchange. You don't trade it from your office anywhere. 60% of the activity taking place in developed stock markets takes place from co-located servers. We are based in Paris. The servers are based for example, Germany in Frankfurt. It takes me 5 milliseconds to trade all of DAX. It takes me 10 milliseconds trade of all of LSE because my servers are on the exchange floor, which means that I don't have to spend time setting my order. Algorithms will make, of course, all the way from Paris to London. It's going to take a lot of time. A lot of US firms are dealing in European markets based in Chicago or New York, but the servers are on the exchange, which means that they don't have to cross all the transatlantic link, which is going to take them 60 to 80 milliseconds. So latency is increasingly important. So co-location comes in, extremely good IT infrastructure comes in. For every trader now, we've got 3 IT experts working. When I talk about IT expert, I'm talking about a developer who codes everything in C++ because it's the fastest language we can use. Second, a guy who's an infrastructure expert who's going to take care of my infrastructure and make sure that my connections are running as they're supposed to run. And number 3, a database guy who makes sure that all the data that I'm getting and deciding on that particular data is actually relevant data. Because if I'm using the wrong data, in the case I've got a huge problem. Finally, these are also processes. Why processes? A lot of guys are trading stock markets against bond markets. It's something which is very popular, especially the German markets. The DAX is the equity index. It's being traded against bond global shacks, which are 10-year, 5-year, and 2-year bonds derivatives. So these process relationships are really being worked on these days. It's something which is quite profitable because they're derivative in nature, so there are no margin requirements. So again, I'm going to explain a bit later. The problem with these guys is that electronic market makers, they are 100% liquidity providers. They place orders, they never hit the book. I don't know if you know what hitting book is. Hitting book is when you've got a bid, you just go and hit the bid. You cross the spread. This is top of the book. Bid offer. When I cross, I hit 20. So I'm basically taking liquidity. The guy who is placed 20 here, let's say it's 20 stocks, he's providing liquidity. So when I'm saying that I'm a provider, I basically, place my order here. I don't want to get executed right away. I don't know when I'm going to get executed. Eventually I would, maybe I won't. But the guy who crosses the spread and hits me, he's taking liquidity. So I just want to clarify. These guys, they're 100% liquidity providers. These guys, they're 50% maker, 50% taker. Half of the time they're providing liquidity, half of the time they're crossing the spread and hitting. So, and finally the difference is this. The holding period of statistical arbitrage guys starts from 2 minutes and can go up to like 1 month holding period. But they do it like, intraday, so it's part of high frequency trading guys. And finally, index arbitrage. Index arbitrage, I'm sure you would have gone through that in your finance class, is, you trade derivative against the cash market. So, S&P 500 has got 500 stocks, constituent stocks. There's only one future, which is traded on Chicago Market Exchange. That future basically cracks the index in general. The problem is that during the day, there are a lot of inefficiencies between the cash market and the futures market. It's very small nature, 2 bips, 3 bips to 5 bips max. We saw that on 18th of September when Lehman Brothers went bankrupt, that spread went down to 20 bips, but that's really very rare. The idea is that eventually this thing has to revert because it's the same underlying S&P 500 that has to crack the index. If it doesn't crack the index, it's got to, some inefficiency which we can exploit quite rapidly. So very simple idea, if the future goes down and the cash doesn't move, you buy a future, you sell 500 stocks in front of it. They're totally hedged. You don't have any market risk. You are basically trying to capture that small inefficiency. The problem again is it's very high frequency in nature, sorry. These guys usually on average trade between, in Europe, the market is $38 billion a day traded across Europe. These guys are responsible for around $4 to $5 billion of notional trade. So it's a very huge activity now. The common threads, what makes them common is that there's automated coding. You're not going to get your telephone and trade. Everything is being done by servers, by server farms, which are located on the exchange. You need very reliable low latency systems. Some IT guys are paid better than traders now, because those guys have, the knowledge and capability to make sure that the system is up and running and it's reliable. And finally, the revenue per share traded is ridiculous. So it's not for retail investors. You're trying to make 1/10 of a cent with every share traded. To make this activity, really interesting for institutions, you need to trade approximately 500 to 600 million shares a day to just start making some good money on a daily basis. So what is it? It's EMM, it's Terra, 100,000 of orders per second, massive cancel and replace. On any single day you can send up to 3 to 4 million orders. And you're not going to get executed on all of them, of course. You might get executed on 1% of them. But the idea is to just keep on flooding the market with your orders. It's very opportunistic. You don't need to trade. If you trade, there's an opportunity. Otherwise, you're not going to force yourself that I didn't trade today. So, it's really, just keep on cancel, replacing. Eventually, you're going to trade. And you, trust me, you trade a lot. But the idea is that, you don't have to do it. If you do it, fine. If you don't, well, you can do it a bit later. Finally, NYSE has this program which is known as Designated Market Makers. New York Stock Exchange has always had specialists, one guy dealing with a certain stock who's a market maker. This is Shamyl, who knows all the client order flow, who is basically a market maker in the sense that he takes the client orders and tries to match orders all during the day. This system has been changed by DMMs. DMMs are totally electronic in nature. They are just coding the market. They will have fair value for every single stock, and they just keep on, flooding the market with their best offer, best bid, best offer. The idea is again to make sure that if somebody wants to trade, he would trade. So there you go. And finally, there are wholesalers like Knight, Citadel, UBS, Citadel. These guys are quite funny actually. They are not prop traders. A prop trader wants to trade, let's say, 100 million of certain stock. He's going to call Citadel. Citadel will say, okay, I'm going to give you the price, just give me all your risk. He's going to take all his risk, and then he's going to start, getting out of that risk easily during the day. And he has to do it during the day because he cannot sit on such a huge inventory. So these are what we call wholesalers. They're not prop traders. Again, this is what I wanted to explain later on by that diagram. So he's bidding at 20. He's offering 20.01. He's risking only $2,000, just for example here. He's trying to capture $1 of spread. Why? Because 100 shares, 1 cent of beta spread. So he's trying to capture only $1 of revenue, of a profit. However, exchange rebate is 25 cents. What is exchange rebate? This is a new concept for Europe actually. It's been going on in the US for the last 5 years. The idea is that if you provide liquidity, you don't pay any fees. There are no fees anymore. Eventually, you're going to actually get paid to provide liquidity. The idea is to attract liquidity. Liquidity is what makes an exchange trade. So if you're going to, sort of like provide them with these incentives, people are going to trade. So that rebate is very important now. For last year, that rebate was around $4 billion. $4 billion globally was actually given out to people as paid. It's not like, it's not exemption. It's actually paid in cash for that liquidity provision. So $1 of rebate, 50 cents of exchange rebate, total revenue $1.50 for $2,000 generated for $2,000 of that risk. So your margin of what you generated is 7.5 bips, which is pretty reasonable given the fact that you're going to do it like thousands of times in the day. So that gives you an idea of how it is. What is not, because that's the problem with high frequency trading. When the brokers are using it to execute institutional orders, that's not HFT. The key difference between these guys, the brokers and the HFT guys is they don't enter orders as often as possible. They do it like, 3 or 4 times a minute. They're not going to do it thousands of times per second. And they have to get done at the end of the day because that's how they're going to get paid. They're not opportunistic. If somebody calls him and says, I need to do it, he has to do it during the day. He's got this time limit and he's got to get his whole order done in that time. If he doesn't get it done, he's not going to get paid. So that's another difference. So let's talk about market structure and especially why these guys are so much in popularity these days. So what has gone on in the last 7 years is because number one, technology. The servers, I'm talking about in the sense of the capability, the system capability to send so many orders, in the sense and having some really good infrastructure to back it up. It's only been quite recent. So faster, less expensive hardware allows you to basically sort of invest in this kind of activity, which was not the case 8 years ago. New quantitative trading strategies, because now a lot of guys have, the talent pool is huge now. You want a programmer, you want a quantitative analyst, you can get it quite easily. So, you can really invest in it. D.E. Shaw, one of the biggest high-frequency firm, has actually an office running in Mumbai. They have hired approximately 500 PhDs, average analysts, and all of their research is being done in Mumbai. So, because it doesn't cost them much. So that's allowed them to really proliferate and invest human capital in this activity. And finally, response time has gone from minutes to microseconds now. Now, when you talk about latency, you're in the microsecond range. It was the case, 7 years ago when it would take you approximately 30 seconds to get an order confirmation from the New York Stock Exchange. It's no more the case. These exchanges have totally changed in the last 7 years. I don't know if you know about this, but as I said, the maker-taker model, you're paid rebate now for trading. This is something which is, which had been like a total dream 7 years ago. Any other exchange which is not in the developed market is still on the taker model. Every time you trade, you pay, and you pay a lot of money. You're talking about 15 to 20 steps for every single trade. Now, for retail investor, it doesn't mean a thing, but imagine if you're trading thousands of times in a day, if you start paying 15 bips, knowing that you might make 7.5 bips if everything goes well, you're always going to lose money. So with that, maker-taker model, it's even if you've got a very small edge, 1 bip, 2 bip, you're willing to trade because you know that eventually you're not going to make, you're not going to pay any fees, but you're going to get paid for it. That's something which is quite interesting. A very highly competitive environment. Before you had New York Stock Exchange, you wanted to trade Time Warner. There was only one guy who could trade it for you, who was at the specialist in the New York Stock Exchange. Now, if you want to trade Time Warner, you can trade in 6 different venues. So there are BATs, these are small ATS, which are alternative trading destinations, which is basically that single stock Time Warner can be traded in different venues, and it's all fungible in the sense that if you trade with other exchange, it's the same Time Warner, nothing has changed. Which means that before New York Stock Exchange or NASDAQ had monopoly, now NASDAQ can trade NYSE stocks, NYSE can trade NASDAQ stocks, BATS can trade NYSE, BATS can trade NASDAQ. So the market has totally opened up, which means that before NYSE could put on the table, hey, this is what you are supposed to pay as fees. It's no more the case, because if he does that, BATS, the other exchange, is going to say, listen, I'm going to cut the fees by 2. So there was this huge competition going on in that market, which has totally, I'm going to show you actually how the fee structure has gone down in the last 7 years. So the specialists don't exist anymore. Everything is electronic. You trade against somebody who you don't know, who might be in Zug in Switzerland, but you're going to trade against him thinking that might be special. The specialist doesn't exist anymore. Everybody is a phantom now. Everybody is co-located on the exchange servers. Everybody has sponsored access, and everybody has direct exchange data feeds. Again, there has been regulatory changes which have forced NYSE to break its monopoly. The regulation ADS, NMS, etc. I won't go into the regulation. The idea is very simple. They broke the monopoly. The antitrust guys went up to those guys and said, "You guys are taking undue benefit of your regulatory position. We're going to break you up. Either we break you up, or we're going to allow other people to enter the market assets." And NYSE decided that it's better to have some new guys coming in than to get broken up. Finally, decimalization. 2000, you could trade the stocks in 1/8. There were no decimals. Now you can trade at 0.001 decimal. So you can easily trade penny stocks, which is not the case, 7 or 8 years ago. And finally, algorithmic trading is really in vogue. Everybody is on algorithmic. 70% of everything that gets traded is algorithmic in nature. There are no humans involved anymore. Human beings are behind the system, making sure that everything goes perfectly. They are designing the system, but they're never ever gonna intervene personally there. So that's something which has changed quite radically. Automation is the name of the game. Everything is being done to make sure that the human element goes out of the equation. Finally, the yoke, there was this English construct, which means that now a broker, when he wants to send orders, he's not going to send it to New York Stock Exchange, he's going to send the same order to 5 different exchanges across the world. So, which has allowed them to, first of all, internalize, internally. Let me explain this. In an investment bank, there are different guys trading the same stock for different reasons. Number 1 might be trading for a client. Number 2 might be trading for a mutual fund. Number 3 for hedge fund. Number 4 would be a prop trader. The prop trader wants to buy. The client wants to sell. They don't have to go to the market. They internalize. They trade internally, which has been allowed by the new regulation, which was not the case 7 years ago. 7 years ago, you were not allowed to do that. You had to go to the market to print the tape that this deal happened. Now it's no more the case, you can internalize. So that has sort of like automated quite a lot of manual procedures. Finally, this is, I think, the most important point. There is a robust private network which is not accessible to anyone. It's only accessible to the big guys, which allows them to basically connect to all the exchanges, all the brokers, and make sure that they have access to all the liquidity that is there. Because if you don't have liquidity, you cannot do anything. Liquidity is the name of the game. And this robust private network, there are approximately 120 guys really connected to the system that allows them, everything that they want in terms of reliability of connection and latency savings. Finally, why did I explain all this is because of those implicit and explicit trading costs, and that has been the key factor behind high frequency trading. Again, if you pay so much money to exchanges or to in these trading costs, you're not going to trade. Okay, just to drive home my point. Here is just a small chart that I bought from Goldman Sachs. It basically shows the blue line here is the S&P 500 index. This line here is when Lehman Brothers went bankrupt and all hell broke loose. The next 2 weeks afterwards were like the most horrible times for a lot of people who have been in the market the last 10 years. And VIX is actually an indicator of the market's volatility, how volatile the market is. So when Lehman Brothers went bankrupt, the volatility shot up. And all of a sudden, this black line here is actually the depth-adjusted beta spread. That difference that I was trying to say there, it sort of like generalizes it for S&P 500, the whole of the index. Just don't look at the numbers, look at, the relative value. So you have seen that, since 2003, when high-frequency guys started coming in, regulations started changing, there's only been like, one trend until July 2007, when the first quantitative crisis really hit the American markets. Since then, of course, the spread started going up, but at the same time, the S&P, it fell approximately 40% during that time. But the spreads, except from Lehman Brothers fiasco, they really, at a level which are quite interesting in the sense that had those high frequency guys not been there, God knows where the beta spreads would have been. And just, I'm going to adjust that with the VIX, which means that I'm going to adjust the beta spreads by the volatility of the market in general. And then you will see that, despite the high volatility, even these days, the beta spreads will actually, never be so low. Again, it goes to show the competition and for liquidity in this market. Don't look at all the numbers, just look at these numbers. High frequency guys basically are in liquid stocks, because if the stock is not liquid, nobody's going to trade, nobody's going to cross the spread and hit them. So these guys are really active in these kind of markets, Nasdaq, NASDAQ 100 and NYSE 100. Look at the spreads from 2007 to 2009, 2000 to 2006 to 7 and 9. 31% a decrease in beta spread quoted. NASDAQ 100, that has been approximately 50%. The spreads have been halved in approximately 4 years. And this number is huge in the sense that stocks are much higher now, much more opportunity to quote. Transaction costs, which I had explained later on, that with the advent of high-frequency trading, the beta spreads have gone down, the fees, exchange fees have gone down. So look at, the spreads in basis point. This is for like, if you want to trade 10 million euros of an index, how much does it cost you? It doesn't cost much. Since from 1998 to 2008, it's literally been divided by 2. Again, as I said, that NYSE, NASDAQ, they don't have monopoly in this market anymore. So this is just for the stocks quoted in the NYSE. For those stocks, NYSE has only 25% share. A quarter of those stocks, they only get traded in NYSE. The rest gets traded on other venues. So you're talking about NYSE Arca, which is their electronic network, NASDAQ VIX, which is the Boston Exchange, BATS, Direct Edge. So NYSE has only a quarter of its share. And a lot of it is because of competition, brought in by the other participants. The same goes for NASDAQ. Only 31% of those stocks which are listed on NASDAQ get traded on NASDAQ. The rest, gets traded elsewhere. just don't look at the number, just look at the percentage of market with the matched volume. So 25% Nasdaq, 16%, 30%. It's very well divided. The whole market trades approximately from $270 billion to $300 billion every single day, which is quite impressive in the sense that there is a lot of opportunity in terms of notion traded every single day. There is no monopoly. There is a lot of interesting opportunity for latency arbitrage, which means that you can trade NYC against Nasdaq, you can trade Nasdaq against BATS, you can trade BATS against direct edge. So it's something which has spurned a lot of high frequency shares. Same structure, but for Europe this time. All of Europe trades 38 billion euros every single day. So there is no comparison at all with American markets, and this is all of Europe. So you're talking about LSE Group, which is the London Stock Exchange Group, Euronext, which is France, France, Netherlands, Belgium, and Portugal. CAIX is what we call an ECN, an ATS, which means that it's not based on, it's not a national platform, it's supranational platform. Deutsche Börse is the German market. The Nasdaq OMX, Nasdaq actually bought the Scandinavian stock exchange, which is OMX. So again, just look at those numbers. It's very reasonably. There is no one big player apart from LSE Group, and LSE is quite rapidly losing its market share as well. Again, just to drive home the point of where the market stands in Europe, LSE, Euronext, Deutsche Börse, stocks are you can trade in different venues without any problem at all. And you can see that in FTSE 100, this is like for September 2009, $1 billion traded on that vehicle platform. So FTSE 100 traded $120 billion and for 20 billion euros, out of which only 80 billion were actually traded on the London Stock Exchange for the English stocks. The rest was traded elsewhere, CAIX, BATS, Nasdaq, etc. This again, I'm just comparing New York Stock Exchange with Nasdaq and what has gone on since the last 2 years, and where you can compare it with average daily volume in those bars with their market share. So you can see that New York Stock Exchange is at 45% in January 2007. As of yesterday, they are at 28% now. So they have literally lost almost 20% of the market share in the last 2 years. They've got huge problems. Nasdaq's the same story. These guys are just being destroyed by electronic commission networks, by the regulation, which means that there is no such thing as monopoly anymore. In US, we've got this kind of weird system, which is tape system. Tape A, Tape B, Tape C. Tape A are those stocks which are listed on the New York Stock Exchange. Tape B are the regional stocks. Tape C are the Nasdaq stocks. So New York Stock Exchange can trade all of those stocks, of course. However, their market share is different for those stocks. Just look at their Tape A, which is their stocks listed on New York Stock Exchange. 66% January 2007, 36% as of yesterday. So it's horrible, what's going on with these exchanges these days. Same goes for Europe. Europe, this is, the triangles here. It represents the MTF, the multilateral trading facility, the supranational exchange that I talked about. They were 16% October 2008. As yesterday, they are 25%. So a quarter of volume getting traded is not getting traded on exchanges, it's trading. It's getting traded on those electronic commission networks, those MTFs. So something which is quite interesting in the sense that the more this market opens up, the more opportunities going to sort of present for the guys who are great entrepreneurs in the future. What are the benefits? Liquidity. They are the biggest liquidity providers at the moment in the whole wide world. I'm not talking about US, Europe. Asia Pacific is not really the case because again, this market, the regulation has been quite slow in Asia, especially in Japan. But it's going to open up this year, so hopefully that's going to be the case. The spreads, I showed you those graphs showing you the bid-ask spread. The spreads have gone down quite amazingly. Exchange competition, there is no more monopoly. transaction costs. Transaction costs, as I told you, like, it's gone down by 2 in 3 years. What are the complications? $4 billion per year of rebate that the exchange is giving if you provide liquidity. You're a liquidity provider, you get paid. This is something which is quite interesting, if you are hogging the national risk-weight offer. Interpositional effect on latency arbitrage. Latency arbitrage, as I explained to you, you've got two platforms. One platform is not technologically advanced. It's the matching engine takes, let's say, 50 milliseconds. Against that particular exchange, you've got, an entrepreneurial ECN where the matching engine takes only 50 microseconds. So there's an opportunity, a risk-free opportunity for arbitrage, because you can trade on one exchange knowing that you can get traded on the other exchange within 50 microseconds. This latency arbitrage is something which is quite amazing as such for all the guys involved. Profit margins have gone down for brokers. It has gone up for the high frequency guys, gone down for brokers. So brokers are in really bad shape, especially in the last 3 years, because just of the fact that the biggest guys who can get you out of risk are high frequency guys. The problem is liquidity provision is temporary, small size without obligation. I can switch off my algorithms today. I don't have any obligation to trade. So that's something which is a complication for the market space in general.